Hi, this is Michael King. We're going to talk about basic concepts for corporate finance, part 1. We're going to cover two sections, corporate finance, which is section 2.5 out of the Booth Cleary's Rikita textbook, and types of business organizations, which is section 2.1. So when we talk about corporate finance, what do we mean? Well, the word corporate means corporations or businesses, and really it has to do with how a business manages its money. In the textbook, they define it as the financial management of assets of a corporation and corporate financing decisions. In other words, we're talking about how a company will raise capital, how it invests capital, and how it ultimately pays out that capital. More broadly, corporate finance is about how bigger businesses will manage their finances. This course is not going to be about entrepreneurs or small businesses. It's really looking at large publicly listed businesses. If you want to learn about smaller businesses, you would need to take an entrepreneurship or a venture capital course. A corporation, as we're going to see, is a business that is organized as a separate legal entity, and it has limited liability for its managers, as well as its owners. The owners control the corporation, but may not be actually managing, in which case they're known as shareholders. There are going to be other forms of businesses that we'll discuss in a moment called sole proprietorships, partnerships, and trusts. So here we have a picture of everything that a corporation does. You can see the internal picture shows that there are three main functions for the CFO and his team. You can see there are three main functions for the CFO and their team: operating, financing, and investing. Operating is really about running the business and earning a profit by managing costs and growing sales. Financing is about how you actually raise capital to purchase those assets, as well as the return of capital. Investing is about acquiring assets, whether they're short-term or long-term, and whether they're tangible or intangible. Effectively, these three parts, operating, financing, and investing, will show up on the cash flow statement for a company. When you think about a company, I like to think of it as the assets that the company owns, which generate value for the shareholders, and how they finance them using a combination of liabilities or debt and equity, which is the ownership. Now, the balance sheet is only one of the three main financial statements. You can see here a stylized income statement where after paying all operating expenses, interest expense on any debt, and taxes, you have the net income, and any money that is not returned to shareholders in the form of dividends is reinvested in the business. Another way of looking at this is the statement of cash flows, which reconciles what happens to the cash balance on the balance sheet over the course of the year. And it has to do with the cash that's used or generated by operations, by investing, and by financing activities, which you can see here. So the types of business organizations, we've talked about a corporation, we'll come back to it in a moment. A typical small business is usually a sole proprietor, which means it's owned and operated by one person. Now, the disadvantage of a sole proprietorship is that legally, the one person is responsible or has liability for everything that happens. This is called unlimited liability. The sole proprietor, their finances and the business's finances are the same. So any income that's generated by their business goes on their personal income tax return. They also are responsible for investing any money into the business, could be their own equity or savings invested in the business, and if they take out any debt, it has to be based on their own credit and ability to repay. When there's two people or more, they typically form a partnership, which may or may not be formalized with a legal agreement. And there are two main types of partnerships: limited liability partnerships, or LLPs, and limited and general partnerships. With a limited liability partnership, as the name suggests, the partners have limited liability, however, they still report income on their personal income tax return. When it comes to a limited and a general partnership, it combines two different forms. You have passive investors who have limited liability, and then you have general partners, or GPs, who run the business and have unlimited liability. So you can see here it combines a partnership with some of the features of a proprietorship. General partners, however, are usually set up as a corporation, which provides them with limited liability that way. And this general partner model is what you typically see with a private equity firm. So, for example, if you take Onyx, which is a Toronto-based private equity firm run by Jerry Schwartz, when Onyx raises capital from investors through a fund, in this case Onyx Partner 5, they raised $7.2 billion, where Onyx actually contributed as the largest investor around $2 billion and raised $5.2 billion from the limited partners. And those limited partners might be pension funds, they might be insurance companies, or high net worth individuals. A trust is a type of legal entity that separates the ownership of the assets from the control of the assets. So the trust itself will hold the assets, and then investors will actually buy units in the trust, which is why they're called unit holders. Notice that they're not buying shares because they're not strictly shareholders or direct owners. There's only indirect ownership. These unit holders will then receive distributions of cash in the form of dividends or a return of capital. Now, trusts are quite tax efficient because any distributions that are made to the unit holders are paid out of pre-tax income. So the trust can effectively figure out a way to avoid paying any corporate tax. And this is how you typically see mutual funds, real estate funds, oil and gas trusts, income trusts, and royalty trusts set up. However, it's important to know that the law governing trusts is different from the law governing a business. We talk about trust law, and business is covered by corporate law. And so the rights of unit holders are quite different under trust law. Okay, so let's come back to a corporation. So a corporation itself is a distinct legal entity, and it has an unlimited life. So it is considered to be immortal. The shareholders, who are the owners, have limited liability only up to the value of the money they've invested in the company in the form of their equity. And you can identify a corporation because its name typically ends with an Inc., a Limited, a PLC in the UK, an AG in Germany, and there's other types in different countries. So you'll set up a corporation using articles of incorporation, thus the word corporation. You will put in place a board of directors, which is there to represent the shareholders and oversees management, including appointing and firing or paying the CEO. The shareholders have elected that board, and they also must adopt the financial statements and approve the auditors every year at a meeting called the annual general meeting. Now, the problem with a corporation is that it's subject to double taxation. Any income that's earned is paid, there's tax paid at the corporate level, and then out of those after-tax earnings, you can also pay dividends to shareholders who, when they receive them, they have to treat that dividend as taxable income. Now, the corporation used to have a primary goal of simply enhancing shareholder value or making the stock go up. But recently there's been a lot of focus on other stakeholders, and we're moving from shareholder capitalism to stakeholder capitalism, which means we're taking into account the interests of employees who may not be shareholders, customers, communities where the businesses are located, and broader society. That's it for part 1.